Open your portfolio right now. If you own 20 stocks, here's a simple question. Are you actually diversified? Because most retail investors aren't. You might own HDFC Bank, ICICI Bank, SBI, Kotak, and Axis Bank and think you own 5 different investments. But mathematically, that can still be one banking bet. Or maybe you own 3 different mutual funds from 3 different AMCs, only to discover they're all investing in the same companies. Your portfolio looks diversified on the surface. The data often tells a very different story. That's exactly what the Wright portfolio review is built to uncover. It takes your actual holdings, stocks and mutual funds, and audits them using the same objective portfolio construction principles used by professional investors. No opinions, no guessing, just measurable facts about the structure of your portfolio. And it starts by importing your holdings automatically. Connect your broker securely through the small case gateway, and the system fetches your exact stock quantities and average buy prices. For mutual funds, enter your PAN and verify with a one-time OTP through MF Central. Every active and forgotten folio across platforms is pulled into one place. Don't want to connect an account? Just upload a broker export or CAM statement exactly as it is. The system reads the file, recognizes your holdings, and shows you exactly what matched before generating the review. Once your data is in, the audit begins. The equity dashboard provides a composite investment score based on structural health. The one-year return metric shows how your current mix performed against the Nifty 50. The effective stock count reveals the true scope. 12 similar names means you're only making 9 independent decisions. This list exposes the specific pairs of stocks that have moved in lockstep for the past year. High correlation suggests that what looks like diversification is in practice a single bet wearing different names. These cards detail every instance where your holdings cross our published framework limits. Whether it's a sector weight breach or an excessive contribution to total risk from a single stock, the same yardstick is applied to every user. Factor exposure explains why a portfolio behaves the way it does. These bars show if your book is heavily stretched towards specific styles, like momentum or earnings quality, which can dictate how you perform when market trends reverse. The review compares your portfolio's volatility and beta directly against the Nifty 50. This provides a specific measure of your bumpiness, showing, for example, if your holdings typically move 18% more than the broader market. This replay uses actual price history to show how your current holdings would have handled 3 specific market crashes. It calculates the exact percentage drop and the number of months you would have waited just to get back to even. Structural risk is determined by the mathematical links between your holdings. Owning 30 different companies provides no protection if they all move in the same direction the moment the market turns. The mutual fund health score focuses on track records and cost. In this demo, the low score of 16 is driven by the presence of 3 regular plans which carry a significantly higher price tag than their direct equivalents. Overlap is a common source of hidden inefficiency. When 2 different funds hold the same underlying stocks, you are essentially paying 2 separate sets of management fees for the same market exposure. The overlap matrix calculates the percentage of shared value between every equity fund in your mix. Cells marked in pink highlight funds that are largely the same product with 2 different fee structures. These structural redundancies contribute directly to a persistent drag on your long-term returns. This calculation isolates the cost of regular plans by comparing them to the TER of the direct twin of that exact same fund. Over 10 years, a fee difference of less than 1% compounds to over a lakh in your final corpus. Only one of the 8 funds in this mix managed to beat its own category benchmark after fees. The dashboard compares every fund's 3-year annualized return against its index to see if that management cost is actually being earned. Maximizing mutual fund returns requires the systematic removal of excessive fee drag and the elimination of redundant overlap between managers. When the high-level health scores are free, the full line-by-line breakdown is available behind a detailed review paywall. This includes specific research ratings, factor detail for every stock, and a complete fund-by-fund fee comparison. This tool provides objective mathematical facts against universal limits. It does not assess suitability for your specific goals, nor does it ask about your personal risk appetite. Applying these facts to your personal financial journey requires a human conversation with an advisor. Objective measurement is the foundation of any informed investment choice. Once you have the facts about where your portfolio stands, you can book a call with an advisor directly from this page to discuss your next steps.